Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me for this segment, we have Russell Rhoads, Associate Clinical Professor of Finance at Indiana University, to discuss the relevance of key jobs data for the Nasdaq 100 index. Russell, it's great to see you as always. Welcome back to Trade Talks. And of course, we have non-farm payrolls coming out this Friday. It's a key report. My question to you is, why is this more important for the Nasdaq 100 than other market indices?
Well, the Nasdaq 100, I mean, we all know it's comprised mostly of technology stocks, and they're very economically sensitive. And I think that one of the reasons that the Nasdaq 100 has outperformed as well as it has in 2023 is this anticipation that we're going to get lower interest rates in 2024. And I don't know if we should necessarily believe that's going to be the case, but right now, it looks like the market is actually pricing in, and you can use the derivative markets to get an idea of when the next cut's going to be priced in. Right now, it's slightly better than 50% at the March meeting, which I think is very surprising to a lot of people.
Let's talk about the derivatives market. Can you explain what you mean by what the March, what they expect in terms of the cut in March?
Absolutely. And so if you're looking at, I hate to use gambling analogies, but this really is the best one here. If you're trying to get an idea of who's favored in one of the NCAA football semifinal games, and they did this about an hour after they announced the teams yesterday, they showed what the Vegas odds were. And basically that's, Las Vegas will move their odds around based on flow of money. In fact, they were favoring Michigan because apparently Michigan people are more likely to gamble than any of the other three teams involved in it. And so there's a market sentiment right there. But you can do the same thing in the derivative markets with respect to when you think the next interest rate change is going to be. And there are ways to back into what the derivative market's pricing in. Right now, it's got about a 53% chance of a cut in March. The reason that's significant is if we were talking a couple of months ago, the market was pricing in, I think, September for the first cut. So as that date's move forward, we've seen this new leg up in equity indices, and especially in the Nasdaq 100.
So from a trading perspective, what are you looking for on Friday?
Okay, well, I do expect everybody to be on edge with this number. It's the it's the last number this year. Next week, the following week, we get the last FOMC announcement for the year, which right now consensus is no change whatsoever. So it'll probably be a lot more about the language. But there are potential inflationary components of the non-farm payroll number. And I think a lot of people will be paying very close attention to that. One of the reasons that the belief that rates are going to go lower in March is because everybody believes that inflation has been contained. I'm going to be paying very close attention to the dollar numbers that come out of the payroll number. And then I'm also going to be paying attention to the derivative markets and see if there's any change with respect to the anticipation around when we're going to get the first rate cut. Anything that appears to be inflationary, I wouldn't be surprised to see that number pushed back to maybe May or even the June meeting.
All right, Russell, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.